Okay, thanks for hanging around and watching this bonus video. If you are following any of my content, eventually infinite banking is going to pop up. It's a very controversial subject when it comes to investing. Some investors love it, some investors hate it and don't believe in it. Dave Ramsey hates it. Um, I've been doing it for about 11 years, and I don't want to sound I don't know how to come across with this, but some people can see it and some people don't ever see it. And that's okay. And if you're one of the people who chooses not to do this, because Dave Ramsey will not give you his blessing on this, okay? And I have a lot of respect for Dave Ramsey. I used to follow him. Um, I'm a Tennessean just like him. He's over in Nashville. So I get it. Some people just don't understand this process. But I promise you, if you will read it, if you will study it, if you'll take the time to learn about infinite banking, I think it will click for you, especially if you're a advanced thinker, if you love to invest, if you love to be different and contrarian. There are stories about people with PhD level educations who couldn't see this, and they studied it and they read and they spent time with people who were doing, and then they started to say things. Isn't that Bob Murphy's the one I'm talking about? He would say there's 6 things wrong with infinite banking, and then he would get one off and he'd say now there's 5 things wrong, there's 4 things wrong, and it got to a point where he's like, why is everybody not doing this? That's the way it's revealed to you. It doesn't, rarely does it just make sense. There are so many people out there talking about this subject, teaching this subject. When you listen to me, here's what I want you to know. I'm not an insurance salesman. I have nothing to sell you related to infinite banking. I have strong opinions on who's teaching it, how they're teaching it, and what they're teaching. But those are based on people that poured into me and people I've followed and learned from. I do want to say one thing. If you're reading a book, if you're out there and you're watching a podcast, reading a book, or anything, it's probably a derivative from this. This is the original Becoming Your Own Banker by Nelson Nash and the infinite banking concept. Now, you might be reading Garrett Gunderson and the Rockefellers method, or you may be somebody else who's talking about banking on yourself. There are dozens, if maybe not hundreds, of other programs people are using to talk about infinite banking. Some of them, I'm afraid, are just trying to sell more life insurance. Some of them are genuinely interested in helping you build your own bank. And I want to, talk about some of the basics of infinite banking. There's no way I'm going to be able to teach you this concept and you to walk away with it. But there are some misconceptions out there, and I want to speak to those. And probably the first one, and I'm ready to write on the whiteboard, but I'm not sure what I'm going to write. But the first one I will write is, it is not an investment. And some people, that's where we've got to start from, because if you're investment minded like I am, and I think a lot of my investors are who are in the fund are, they're investment minded. This is before the investment. Where do you invest from? And even before that, where are you putting your money? So most W-2 earners, they don't even get a check anymore. It's automatically deposited into somebody else's bank, someone else's bank. And while your money sits there, they have control of it. There are so many things you have to learn, but the Federal Reserve allows these banks to multiply your money and lend it out to other people. That's the product banks have. Banks sell money. They rent money, and you pay them back in rent. It's no coincidence that banks, it doesn't matter. Have you ever noticed how big the town is? If you're in a little one red light town, the biggest, nicest building typically in the town is the bank. They make money hand over fist because they control the banking process. And the banking process is just pivotal to life here in America. You have to have banking. You have to have finance and financing. And if you're in real estate or investments, you need capital. So it comes down to, where are you going to store your capital? Okay? So we all are going to store our capital, and you've got to get over the fact this is not an investment. You're going to put your capital somewhere. Why not control it? Why not have control over it instead of giving up control? Now, this is not something you snap your fingers and can do overnight. you have to fund any kind of business you start, you have to fund it. Sometimes it takes years to fund it. And what you're going to do is fund your first policy. Now, let's talk about what a policy really is, or let's talk about having your own pool of cash. If you had this pool of cash, and let's say it had $250,000 in this pool of cash, let's just say you started life with that, and it wasn't even your money. You needed to buy a car. What would you do? You wouldn't go to a bank. You would go to this pool of cash and take the 40,000 or whatever it took to buy the car, and then you would pay it back. So just imagine if you did that, and let's say that you did that with interest, and you could charge yourself any amount of interest. But if you had a pool of money that you could always go to, and then you paid it back and kept paying it back, it would start to grow. You would have no leaks. You would be capturing all the interest instead of it going to the bank or to some credit card or some other form of credit or even leasing. You could capture that money back into your bank. Some people, this helps them get this concept. A lot of people think about borrowing from their 401k. When you borrow from your 401k, if you had 250,000 in your 401k and you needed to borrow 40 to buy a car, what happens? Well, now you only have 210 in your 401k, and you have an asset out there that's rolling around that's free and clear. We love to say that, or we would say that, but we would have payments on it. But you wouldn't be still earning on this 250. You would only be earning on 210. What infinite banking and what a whole life policy allows you to do is, instead of dropping that to 210, you just borrow this 40K against that as collateral. So you never touch that principal balance. And because it's so rare to see true compounding, everybody knows compounding is the seventh wonder of the world, or whatever, the eighth wonder of the world. But we rarely see it because the human condition intervenes and causes things that break this. And car purchases and things like that break this compounding. If you can leave this money alone and truly let it compound for 40, 50, 60, 70 years, do you know what that can do? But the problem is we break the chain, we break the compounding. Infinite banking simply allows you to not break the compounding, okay? So it helps you control your own money and not break that compounding process. Now, there are some choices you have to make when you pick who you're going with, who you're creating these policies with, but that's a huge one. And the vehicle is whole life insurance, and this is where Dave Ramsey, he just flips out. He hates whole life insurance. But what we're doing is we're funding whole life insurance, not worried about the death benefit. We're more worried about finance, because Nelson Nash says early in life, your need for finance is much greater than your need for death benefit. Now, you still need death benefit, but you may not need as much. And the beauty of whole life is, as you continue to fund this, the death benefit goes up over time, okay? So as you get older and you have more net worth, your insurance grows with you. And as you get older and maybe you come upon things that cause you to not be insurable anymore, you will always have insurance, and every year the dividends of your policy will be used to buy more insurance, and you're guaranteed they can't turn you down from that. So even if you had a cancer diagnosis in your 50s, you can continue to buy your whole life insurance through your dividends, adding every year, and that's where this growth comes from. Liquidity is huge. Having this money in a 401k, the government wants it locked up. They want you to stow it away, stack it, and never touch it until, and then you're afraid to spend it once you get to retirement. So it's such a scarcity, it's just anchored in scarcity. And I hate scarcity. What this does, it allows you to always have liquidity. And imagine if you were out making these investments, you wouldn't be necessarily buying $40,000 cars, but you might be making $50,000 investments. And these investments are going, and they're throwing off money, and you can do whatever you want with that, but the good thing to do is to use some of that money to pay back this. And so this pool of money is always growing. And with Nelson, he always said, we want to think long term. You want to be looking into the future. So this pool of money is not only there for you, it's there for your family and your children. And someday when you do pass, this passes to them tax free. It goes, the death benefit is tax free, goes to your children. So that's another great reason to do this, is the tax advantages. This is just like a 401k. It's like a Roth. You fund it with post-tax money, but it's never going to get taxed. Now, there are some rules in there, and you have to be careful, because about 40 years ago, Congress created some rules because the wealthy were using these things to really create some huge tax advantages. They're still there, but Congress had to step in. And now, does that tell you something? When Congress steps in to change things, um, it's obvious that something was going on there that had been found. This is what we did before the 401k. The 401k has only been around since the early 80s. So people needed a way to protect their life, and also it had this savings component. But they didn't know how to overfund it like we're doing today to get huge amounts of money that we can go do asset purchases with. So that's the best thing about this, is opportunities. Okay. So if you had a 401k with $250,000 in, and your rich uncle called you up and said, hey, I've got a business opportunity. It's a sure thing. And the problem is it's got to be, I want you in with me. The problem is I need you to come with $250,000 by Friday. And you had to, and he threw that in your lap. How many people could take advantage of the opportunity of a lifetime if they didn't have a liquidity base like this? And that's what I want you to have for yourself. I want you to be able to take advantage of opportunities that come along, and not have to call your 401k provider and beg them to let you out and worry about fees and the surrender. What is it? The 10% penalty for taking your own money. It's your money. And then you'd have to pay taxes if it's in a 401k. And by the end of the week, you would have missed the opportunity because you're sitting there worried about the taxes and the fees. I hate that, and I don't want that for anybody, especially those of you that are investment minded and are forward thinkers. So this is why infinite banking is so strong. It gives you that as well. And the long-term legacy planning of this, the goal is to have so many policies. Nelson Nash died. I think he controlled or had at least 40, something like 46 policies. They weren't all on himself. Some were on his wife, some were on himself, some were on his children, his grandchildren. And as he passed, or at different points in his life, he would give those policies to his grandkids and to his children. So this can become a huge place to put money. Now, you don't have to be just stinking wealthy to do this either. A lot of money's passing through your hands. And this is where the real thinking comes in. I love to help people strategize, but money passes through your hands. Maybe you're a business owner and you've got a lot of money sitting in the bank waiting to go out in payroll. Or maybe you've got these accounts receivable that rolls in, or you have windfalls, but sometimes you have a lot of outgoing. That's what infinite banking, that's where it works perfectly. It flourishes in a business owner environment where you can use this to pay quarterly income taxes, and then you can put monthly back into this. You can use money that's your money, but instead of sending it into the government, maybe you hang on to it, create a policy, then send it into the government. I joke around and use the word that I launder as much money as I can through my policies, because once money's put into a policy, you will never lose control of that dollar. And I love that thought. If I go buy a car and I write a check, that money, that 40K, is gone to the car owner, the car manufacturer. If I borrow the money from my own policy, and yes, I use the word borrow, and borrow means you should pay it back. If I borrow the money from a policy, I am, yes, indeed, handing 40,000 to them. But I really never lost control of that 40 because it's still earning. There's no loss on opportunity cost. So the 40, instead of sitting in the car in the driveway doing nothing, the 40 is really earning because it's still here. It's still here, still earning compounded. And one of the best things I ever saw, and I'm checking time, we're at 15 minutes, is when people save, let's say you save money and you save for a car. This is kind of what you're doing. You're saving and then boom, you're back down here again. And then you're doing this. Okay, you're saving and then you purchase and boom, you're back down to zero. I think this is the perfect image of what people are doing. But with infinite banking, this is what you're looking to do. You're going to save, 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 boom. But you're only going to fall so far. Then you're going to save, save, save. This is the image of infinite banking. Not great, but there you go. So over time, you're starting to grow, and then infinitely it grows like that. That's it. If you're a saver, a cash payer for cars, this is what you're doing. The funny thing is, if you're a debtor, you're doing the opposite. You're doing this. And you go back into debt for another car. So it's that right there sums it up. This is what we want to do. We want to build that ever growing, and the real magic happens out here is like year 7 to 10, and then out here is like year 20, and then my goodness, when you get like 30 years down the road, this thing goes crazy. We're talking about paying a premium. Now, this is one thing that people hate, but you should strive to never stop paying premiums. Okay? That's crazy. That's something we can talk about. But if you're paying premiums when you're 70 years old, I guarantee you, if you can find a way to get $10,000 into a premium into a policy, an older policy that has room, that 10 will instantly become 20 or 30 when you get up in this range. So like I say, even if your Social Security check comes in and it equals 10, if you'll just put it through this system, you put that 10 through this system, out the other end will pop 30 of available cash value that you can access. So these things are magic once they get older. And that's why they're so freaking powerful if you do this for children and grandchildren. And I'm not even talking if you can do $2,500 a year, $5,000 a year for an infant. When they get to be 60 years old, they'll have millions of cash value. They can retire on that cash value. These loans they don't have to be paid back. You can die with loans and the policy will pay off the loans. They'll never loan you more money than the policy can pay off at death. So I have probably really opened the can on this, and you were probably more confused than when you started. But I shot this video so that maybe you can get a primer on it, and then now you can ask me some questions about it, because I love talking about infinite banking. I implement it. I pay hundreds of thousands of dollars of premium every year. Now, I'm not saying that to brag, but I'm saying you should be paying a lot of premium, an uncomfortable amount of insurance premium every year. You won't lose that money. It's not lost money like Dave Ramsey says it is. Cash value accumulates, death benefit accumulates. At one point, they will become one and the same. You don't get them both. That Dave Ramsey can't wrap his mind around that. This is almost like a guaranteed savings account that's going to hit a certain point, and you're going to get somebody's getting a large death benefit someday. And if you happen to die with these loans in place, they're taken care of. So again, hopefully this video is going to stay under about 20 minutes, and that's where I was hoping to get. So don't forget, the best place to start is right here. This book costs about $20 on Amazon. Get it, read it. Nelson taught in parables like another great man I know. You will probably have questions after reading this, and you'll need to read it again. There are all kinds of resources and people out there who are shooting videos that really helped me to get it at some point, and it clicks. It will click if you will give it time, read, think. Take the time to think. Don't let other people fill your mind with things. You need to do your own thinking. So infinite banking, I call my method the SMART A method. SMART is our due diligence process. A is the smart asset, and infinite banking is that A. It's the smart asset. So I hope this video got you thinking. And thank you so much for watching the masterclass, and I hope you enjoyed this bonus video on infinite banking.